Tudor Jones just dropped a bold statement on Squawk Box saying all the ingredients are in place for a massive rally. Today I'm going to tell you exactly why that claim should change the way you look at your portfolio. Paul, the founder and CIO of Tudor Investment Corporation, and a driving force behind the Robinhood Foundation, lays out the macro setup, the bond market signals, and the speculative flows that could push markets much higher. I'll play the clip in a moment, then I'll walk you through my full reaction. What's credible, what's dangerous, and how I'd position for both upside and sudden risk. By the end of this video, I'll also name 2 growth stocks I'd consider buying right now if you want exposure to this rally. If you only watch one video today, make it this one. Before we dive in, hit like, share this with a friend, drop your thoughts below, and subscribe so you never miss the next update. Alright, cue the clip. Let's hear what Paul Tudor Jones has to say.
You were, I think, dare I say, very pessimistic the last time I saw you here back in May. How do you feel now?
Well, it's like the Prince song. It's 1999. Party like it's 1999, right? Feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place. And certainly from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the NASDAQ doubled between the first week of October 99 and March of 2000. So if it looks like a duck and quacks like a duck, it's probably not a chicken, right?
But you think it's 99, and we were talking to Mike Novogratz earlier today. It's not 98. I mean, everyone's it's either 98, 99, but it's not 96, I guess is the point.
Right.
And that's a problem, potentially.
Right.
Or it's maybe an opportunity, but you have to get on and off the train pretty quick.
Well, if you just think about bull markets, right, the greatest price appreciation is always the 12 months preceding the top. So that's the nature of a bull market. It kind of doubles whatever the annual average is and before then. So if you don't play it,
right,
you're missing out on the juice. If you do play it, you have to have really happy feet, because there will be a really, really bad end to it. And my guess is that I think all the ingredients are in place for some kind of a blow-off. Will it happen? Again, history rhymes a lot, so I would think some version of it is going to happen again.
Right.
If anything now is so much more potentially explosive than 1999. 1999, we were looking at a rate hike in November. Now we're looking at a rate cut. We were looking at 4 more rate hikes before we actually topped in 2000. Now we're looking at 3 or 4 rate cuts, probably at least. So you have monetary policy that's going to take us to real rates of 0 or less, probably, depending upon the next Fed chair. And then the big difference is, obviously, fiscal policy. We had a budget surplus in 99, 2000. Now we've got a 6% budget deficit. So that combination, that fiscal monetary combination, is a brew that we haven't seen since, I guess, the post-war period, early 50s, something like that. And that was crazy times, right, coming out of the war.
But you think that most people who are watching us now, you need to be in this market now. But then the question, as I said, is you have to jump off the train before the train crashes, if you're suggesting the train is going to crash.
I'm not suggesting the train's going to crash. I'm suggesting that we're in a period that's conducive for massive price appreciation in a variety of assets. Will it happen or not? I don't know. If you kind of just look, if you just think about the leverage that we had in 1999, you look at margin debt, and then you look at today margin debt, but you have to throw in leverage ETFs because people don't use margin like they did back then. We're probably a little more elevated than we were in October of 99. It will take a speculative frenzy for us to elevate those prices, right? It will take more retail buying. It'll take more recruitment from a variety of from long-short hedge funds, from real money, et cetera. It'll take a combination of those things. It's not going to go up without flows and without a story. The story's there. It's the combination of the most unique and aggressive fiscal and monetary conditions that we've ever seen.
Okay, if you're right, who are the winners then in that, and who are the losers? Because right now we're looking at an NVIDIA obviously being a major winner. Even AMD today,
right,
major winner, but there's this unique arrangement that's almost circular.
The circularity makes me nervous. I would say, and I'm going to think of it in broad terms, I think what the markets are telling you, this is an inflation story down the road. If you look at the biggest winners, right? The biggest winners are gold. I think it's up 46, 47%. Bitcoin, I want to say it's up 50 or 60. I'm not even sure. There's a Morgan Stanley basket that's a retail flow basket that has all the meme stocks in it. It's up 67, 68%. So it's really what retail jumps on. So crypto, digital gold, that's obviously something that's very, very appealing.
And does that mean you're jumping on all of that right now?
Well, I'd want to have positions in all of it, for sure. So if you said to me, what are going to be the winners? Again, we have this race.
Right.
The race, realistically, is certainly to the end of the year, because that's when everyone marks institutionally. And then you have to figure out what's going to go on in next year. So what would I want to have? I'd want to have a combination of gold, crypto, probably the NASDAQ. I think, I want to say that I've said that before, and I think that's still the right one. And I think whatever the fastest horse is at this point in time probably has a good chance of being that on deck 31.
First off, Paul began by drawing a dramatic parallel. He said the market feels exactly like 1999. He referenced the manic late stage of the tech bubble. It looks like a duck and quacks like a duck. It's probably not a chicken. That's to say the setup feels eerily similar. Hype, elevated valuations, big stories, and a sense of this time is different. What I took away, when a seasoned macro investor rings that kind of alarm, we should sit up and listen. He didn't say the train is going to crash today. He said the ingredients are in place for a blow-off. Translation: we could be very late in the cycle, chasing the last leg of a big move. Then Paul shifts to the mechanics. In 1999, you had rate hikes, heading into a top. Today, we're looking at potential rate cuts. Fiscal policy is far more aggressive this cycle. Deficits are huge. Policy stimulus is enormous. Central banks are very visible. His point: the monetary fiscal cocktail is more explosive than 1999 in some ways. To me, that means the upside from here might be large, but the risk is also amplified. When policy engines are this turbocharged, the ride can be wild. Next, he talks about what a blow-off looks like and how to think about it. He explains, in a bull market, the wildest gains often come in the final 12 months before the peak. That phenomenon is classic. The last leg often sees the most manic behavior. He warns, if you don't play it, you might miss out, but if you do play it, you better have really happy feet. This means that if you're going to participate, you need to be nimble, because what goes up big often comes down equally fast or messily. Then the interview pivots to winners and losers under this environment. Paul is clear. The circular deals in tech and finance make him nervous. He says the market is telling you something. Inflation is going to the front burner again. He points to gold, Bitcoin, meme stocks, speculative flows as signaling that theme. In his words, winners today aren't always the traditional big caps. They're the flows, the story stocks, the things people get excited about. That suggests a bifurcated market, some mega winners, many who miss out or react late. He goes on and says yes, he wants positions in all of it. Gold, crypto, the NASDAQ, but the key is how you position them. He's not saying go all in and sleep easy. He's saying hedge, expect volatility, be ready to get off the train before the crash. Let's zoom out and talk what this means for you. 1. Cycle awareness. If the market's in the final stage of a major bull cycle, your strategy should reflect that. It's not wrong to be invested, but you might want less conviction in being fully invested, and more conviction in being selectively invested, and ready for an exit. 2. Diversification into non-traditional winners. Paul's pointing us to assets outside the standard buy the market play, gold, crypto, thematic equities. If inflation reasserts itself, these are the obvious places, but that doesn't mean ignore fundamentals. His emphasis is on story plus flow, plus macro tailwinds. 3. Risk management and nimbleness. The ride up can feel great, but the ride down can hurt. Paul keeps reminding us, have happy feet. If you're going to participate in the late cycle surge, you've got to know where you'll get off. A robust exit plan is essential. 4. Beware of policy risk and structural risk. He flagged that the fiscal and monetary backdrop is unique, maybe more demanding than we've seen since the 70s post-war era. That means standard playbooks might not work as well. Bonds and stocks may both face headwinds. So where does this leave us? Here's my take. If I were in your shoes, I'd lean toward a modest exposure to assets that stand to benefit from inflation or speculative momentum. Maybe some gold, a small position in crypto, some growth themes. But I would not be complacent. I would assume the less probable outcome is everything keeps going up smoothly. The more probable upside is still there, but risk of abrupt change is real. And the most important shift, start thinking, when will I exit or hedge, not just what will I buy next? Because if Paul is right, we might be closer to the end of the ride than the beginning. So that's the breakdown. I think Tudor Jones delivered a compelling case for being alert, strategic, and not casually invested. The market may still reward investors, but it might reward the prepared more than the confident. If you enjoyed this analysis, hit like, comment below your biggest takeaway, and subscribe so you don't miss my deeper dives into how to position your portfolio under these unique conditions. Before we dive into the 2 standout companies that could define the next decade of growth, this video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now, let's talk about our first company, SoFi Technologies. Ticker SoFi. Founded in 2011, SoFi started by helping grads refinance student loans and grew into a full digital bank. Today it offers checking and savings, loans, investing, credit, and insurance, all in one app. It's sweet spot. Henrys, high earners, not yet rich, digital natives who want premium value. SoFi leans on tech and data science to deliver smarter lending and personalized finance. The mission: help members achieve financial independence, with 𝗗𝗜𝗏𝗏𝗧 𝗗𝗜𝗏𝗏𝗏𝗘 with tools, education, and advice. As a direct bank, SoFi avoids big branch overhead, offering competitive rates and high-yield savings. Members can deposit checks, trade stocks, and apply for loans, all from one place. Convenience plus value builds loyalty, the engine of long-term growth. As banking moves online, SoFi aims to be the primary financial relationship for millions. That's the setup. Now, why bulls are excited about SoFi's future? The bull case centers on SoFi's financial services flywheel. Win a member with one great product, like a high-yield savings account or a well-priced personal loan, then cross-sell into investing, credit, and more, increasing revenue per user. More products per member means higher lifetime value and stickier relationships. Its national bank charter is a game-changer. SoFi can hold deposits and fund loans with low-cost capital. That boosts lending margins and gives more control over outcomes. Financial services is enormous and ripe for digital disruption. SoFi is positioned to capture share as consumers demand better experiences. If execution stays sharp, new products, happy members, growth can compound for years. No investment is risk-free. SoFi's challenge is sustaining consistent profitability while growing. Heavy spend on marketing and tech drove past losses, but recent results show real progress, even gap-profitable quarters. Fintech competition is fierce. To win, SoFi must keep innovating and delivering superior UX and value. As a lender, swings in interest rates and the job market can squeeze margins and increase defaults in downturns. Expect volatility. Good news can send shares soaring. Missed goals or regulation headlines can spark sharp sell-offs. This isn't a get-rich-quick bet. It's a multi-year story for patient investors. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Practical frameworks, real-world metrics, and step-by-step lessons to invest with conviction. Now our second growth giant, Uber Technologies, ticker Uber. Known for rides, Uber disrupted the taxi model and evolved into a diversified tech platform. Today it runs on 3 pillars: mobility, delivery, and freight. More riders attract more drivers, reducing wait times and improving service. A classic network effect. That same network powers food delivery, leveraging brand recognition and a massive user base. Management shifted from growth at all costs to disciplined profitability, streamlining and optimizing operations. That pivot is why many see Uber as a serious long-term investment, not just a scrappy disruptor. Bundling perks into membership makes the platform stickier and boosts user lifetime value. Uber for business travel and meals plus Freight's logistics platform unlock new profit pools. Operational discipline is translating into consistent free cash flow, the most convincing proof point of all. Uber operates in thousands of cities, a brand and footprint that's hard to replicate. As travel and commuting rebound, mobility drives revenue and high-margin profits. Cross-usage between rides and delivery turns Uber into a daily utility. Freight applies the same tech to trucking. Route optimization, marketplace matching, and data-driven efficiency. Positive free cash flow lets Uber invest in growth without diluting shareholders, a key de-risking milestone. In short, network effects at global scale plus disciplined execution equals a long runway for profitable growth. Regulation is the biggest wildcard. Labor classification, city rules, and shifting policies can alter costs and operations. Competition is fierce across rides and delivery. Price battles can compress take rates and margins. Macro shocks, fuel spikes or recessions, can strain driver supply and reduce demand. Scale adds complexity. Tech missteps, data issues, or UX misses could slow the flywheel. Investors are betting the team executes through cycles. Stay focused on long-term fundamentals. Side by side, two different industries, two platform models. SoFi grows vertically, deeper products per member. Uber grows horizontally, broader network and services. SoFi, financial and credit cycle sensitivity. Uber, regulatory and operational complexity. Choose based on your thesis: digital banking dominance or on-demand mobility at global scale. Final verdict: SoFi Technologies and Uber Technologies both offer compelling long-term growth setups. They're leaders with strong brands, massive user bases, and clear expansion strategies. Track user growth, revenue per user, and the path to sustained profitability. Consider starting small and adding over time as execution proves out. Classic dollar cost averaging. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or sharpening your strategy, you'll get tools and confidence to grow real, long-term wealth, with step-by-step lessons and practical strategies you won't find anywhere else. Serious about investing smarter? Click the link in the description and pinned comment to join today. Trust me, your future self will thank you. Want exclusive stock tips, in-depth analysis, real-time trade alerts, and free guides? Join the StocksGalore Patreon, link in the description. Which would you pick for a long-term hold, the fintech platform or the mobility giant? Tell us why in the comments. Don't forget to like, share your thoughts, and subscribe so you don't miss the next important investing update. Thanks for watching, and I'll see you in the next one.